Howdy guys, Jimmy Song here. In this video, I'm going to talk about why businesses get so big under a fiat money system. And this is something that I kind of threw out offhand in one of my tweets earlier. And I wanted to sort of expound on this a little bit because it's not clear to a lot of people why fiat money causes really, really large businesses. As a part of the evidence that that big businesses are really kind of unnatural, I want to point out a few things. First of all, if you go to any giant corporation, how many people are really not adding or contributing anything to the profitability of that company? I would guess that it's a lot of them, right? Like if you talk to any management consultant that's done any sort of analysis of the people that are in these companies, they'll tell you like at least 50% of the people in any large corporation, they don't really add anything. They just sort of like get by and don't really contribute much. If they disappeared tomorrow, like the company would run as normal. There's a lot of people in almost any big company like that, and this is not unlike big governments, right? Like most of the people in a lot of these bureaucracies, they don't really add or contribute anything. Like you can get rid of them, and like nothing would really change, right? Like nobody would miss them. Essentially, there's no real value that they're really adding. So that's one piece of evidence, and like if you've seen any like HR department or something like that, you'd be able to identify a lot of people that are like, hey, they don't really do anything. What's going on? How can this company be this inefficient and still make money? Well, here's the answer. So when you think about fiat money, what is fiat money? Well, it's a central bank usually that creates the money. They call it a loan, but it's usually loans to the government or to other banks and so on. There's something called the discount window where banks can basically borrow money from the central bank for a very low rate, and then they use that as their reserve, and then they lend it out, and so on. It's a giant pyramid usually. The central bank has some sort of reserves. In the U.S., at least up until 1971, that reserve money was gold, right? Like it was backed by gold. But then they would lend out some multiple of whatever that gold was worth, and basically the banks that borrowed the money from the Fed or the Central Bank of the United States would lend some multiple of that to their customers, and so on. And this is how you get like kind of rampant inflation and so on. Is these banks keep lending out more money, and they're basically creating more money into existence through loans. And this happens even at like the personal level, right? Like if you take out a mortgage from a bank, when they lend you like $100,000 or something, that money didn't actually exist right up until the point where you actually they lend it to you. It wasn't sitting in a vault. It wasn't somebody's deposit. It's money that they create, and that's because of something called fractional reserve lending. Basically, if they have $1,000 in their vault or in reserves, then they can lend out $10,000, right? That's $9,000 in extra money that they're essentially creating out of thin air through loans. And this is more money in the economy. That's more money that's in circulation, and so on. And that's how your mortgage works, right? Like if you're borrowing $100,000, that's $100,000 that didn't exist before that you are now able to spend on the house. And then for the privilege of the bank creating that $100,000 on your behalf, you pay them an interest rate of some amount where the bank gets to make money. So really, whenever a bank receives a deposit, they're making a tremendous amount of money, and this is why they can have 47 vice presidents in their branch. It's because they have so much money that they can lend out. So, I mean, if you think about it, they give you like 0.5%, if that, on your deposits, and they lend it out at like 4%, right? Like, and most people think, oh, well, they're making 3.5% on whatever deposit that they get. No, they're not making 3.5% on just that. It's 10 times that amount, or many multiples of that amount. And they have to, that's how fractional reserve lending works. Okay, so that was kind of a digression. So how does this lead to large companies? Well, so some of the biggest lenders in the country are commercial banks, right? Like these are banks that don't serve you or me or any individual customer. They only really lend to businesses, and that's their job. That's how they make their money, and they create lots of money out of thin air, and basically they can get money from the Fed, and they in order to make money, they need to lend out money to quote unquote safe places. So essentially, what they end up doing is because they are inherently uh, trying to reduce risk, they lend to the bigger businesses. The bigger the business, the better, because in a sense they're protected in a few ways. One, because the big business presumably makes a lot of money or has a good business, but oftentimes they don't. And the other way is through government bailouts. This is exactly what happened to like GM and Chrysler. A lot of companies sort of depend, or a lot of banks depend on government bailouts to sort of like make up for that loan that might go bad, that sort of thing. So they're motivated to lend to bigger and bigger entities, and essentially in order to do that, and because they're competing against each other, they make the interest rate for the bigger companies very, very low. So, for example, if they're getting money from the Fed at one interest rate, they're going to only charge a tiny premium on top of that, and that's enough to make a ton of money, because the amounts that we're talking about are huge, right? Like it's in the millions, hundreds of millions, sometimes billions of dollars, and like you don't need to make very much on each deal to make, like, whereas like $100,000 mortgage to you is going to make the bank maybe like $50,000 over the lifetime of that loan. When you're talking about $100 million loan to a giant company, you don't need to make a tremendous amount of money or a tremendous percentage in order to make a tremendous amount of money. So oftentimes the interest rates tend to be very, very low. Now compare that to like a much smaller business. They're going to have to compete with the people that are like going for a mortgage or whatever, and they get charged a much larger rate. So essentially, the bigger businesses have access to the early printed money, and this is called the Cantillon effect in economics, where people that have early access to the first printed money get a lot of the benefits. And if you want to know more about that, that's essentially what happened to pretty much every ICO in the space. The VCs and hedge funds that got in on the pre-sale, they got a much better deal than like the public did like 6 rounds later, and usually they got out at a much higher profit and so on. But I mean, it's essentially the same thing. When you have money printing, this is sort of the behavior you can expect. So essentially, what happens is these giant companies get like very, very, very cheap loans, and they have access to that money early, and they can spend it early, so they get sort of the double whammy of a very low interest rate and the early spending of the inflated money. So they can grow, and they can be much more profitable than, say, a smaller business, which has to compete on the market for loans that are much higher rate. And even if they're getting 4 or 5%, I mean, like these businesses are getting like 2-3% interest rates. So there's an inherent advantage in being able to do that. And what a lot of these big businesses do is they'll take the loans at like 2%, and then they will oftentimes like lease out their equipment, or do some sort of deal where the interest rate is like 3%. Essentially, they're using the money from the loan and then like making a spread off of it. Now, this isn't fractionally reserved fractional reserve lending like the banks are. That's like highway robbery. But they still make a spread off of it, and they can do this in pretty large volumes. So essentially they can afford to have a lot of rent seekers in their workforce, and it gets sort of unnaturally large, right? And there's a very good argument to be made that the natural size of a corporation is somewhere around Dunbar's number, which I think is like 147 or something like that. And that's the number at which you stop knowing everybody at the company, right? Like the human brain just doesn't have the capacity. I mean, there are some people that can, but generally they don't have the capacity to know that many people at the same time and be able to keep track of them and stuff like that. That's probably the more natural number. But because of fiat money and like this access and pipeline to the extra funds that are sort of streaming out of the Fed into the economy, and sort of being big helps these companies like grow even faster, and like it supercharges them so that they're motivated to grow and grow and grow without necessarily earning it. So that's what I mean. That was a pretty long explanation. Hopefully that helps you. This song is done.